what we have done, see, very simple. Finance instruments are, you will have a compound instrument also. What is the compound instrument? You will have the characteristics of both equity and liability. Okay, you have the convertible, as simple as that. It will convert. Example would be debt can be redeemed either in the form of cash or it is form of fixed number of equity shares. Is that you can convert the bonds into form of cash or in form of IS 32 requires that compound instruments should be split. You have to divide into two components. What is the amount of liability and what is the amount of equity? Okay, they want to know, what you should know, what is the equity and what is the liability. Okay, these two elements must be shown separately. Okay, this yes, are you here? Okay, are you here, Jasim?
Yes, doctor.
Yeah, fine. Okay, this means if you have a compound element, you have the financial liability and equity instrument. Okay, now you have to show it separately in the financial statements. When you have to show separately, initial recognition, same process. A compound instrument must be split into liability and equity. Now you can make it over, how the things will work. A liability, how we are going to liability component, we are going to calculate. First, we calculate the present value of the liability using the discount rate. They will give you a market rate. With that market rate, we have to discount it. And once we have discounted, the remaining value, the liability component is calculated present value of repayments. Okay, present value of repayment, discount at the market rate. Definitely, there will be some difference will be there. Between the cash proceeds and the issue of the instruments. The difference between the cash proceeds and the issue of instruments is nothing but the equity component. Okay, first we have to calculate the present value of the liability repayments. What is the difference between the present value and the cash proceeds is the equity component. Then automatically we are splitting it. We are splitting the amount of liability and the amount of equity. Very easy, very specific. Is it very easy, very specific. Daniel issued 50 million convertible bond. No issue cost is there. Coupon rate is how much? 10%. Payable in arrears at the end of the month. This is little bit, we have to be very, very cautious. They will somewhere we will get it confused because most of the time they will give a payable annually in arrears. If sometime they will give payable in advance, is it right? Payable in advance, then we have the entire calculations will change. Okay, another thing is most of the problems we are doing in arrears. One or two problems we do in advance. Okay, that is why we have to make a distinction. That is what I want to say. The bond is redeemable at par. Is it? They have issued in 2001. 1, 2, 3. 1, 2, 3. How many years are there? 3 years are there. This is 1st January. Means 2001, 2002, 2003. They have the option of conversion. The terms of conversion is 25-cent shares for every one bond owned, for every $1 owed to the bondholder. They are giving you 225 cents equity shares. Bonds issued by similar equity without conversion rights. What is the rate of interest? 15%. That is nothing but the effective rate. Okay, that is nothing but the effect. Assume that all bond holders will go for option of conversion. How will be the convertible bond accounted? On initial recognition, okay, on initial recognition, we have to do? We have to calculate, we have to split. The steps are very clear. This is the step 1, okay, we have to split between equity and liabilities, okay. The liability How we are going to calculate liability component? The present value of the cash payment discounted at the market rate. The difference between the the difference between the proceeds and the issue, the proceeds of the issue, the difference between the proceeds of the issue means whatever the cash amount we have received and the liability component is the equity. The difference, you have received 200 and the present value of liability is 165. The difference is that the difference is 35 is the equity. Like that we have to calculate. Now, first you have to split it, the proceeds. How much you are taking, you have what they have mentioned. They have mentioned that we are issuing 50 million. 50 million at the rate of 10%. Okay. Here they have calculated. Okay. They have calculated the interest. How much they have calculated interest? Calculated interest of 50 million. I'm putting here it time 10%. Okay. 10%. It comes to how much? 5 million. It is 5 million. It is in thousands. Okay. They are discounting. First year, second year, third year. In the fourth year, what will happen? This is the standard procedure. In the fourth year, it will be the principal will be there 50 million. Is it in the third year? Okay, this is the third year. 1 minute. This is the third year. Third year, principal is there 50,000 and interest is how much? Interest is 5,000. This is the third year. Okay, this is the year 1. This is the year 1. This is the year 2 and this is the year 3. Okay, year 3. We are discounting by the effective rate of 15%. You will get the present value. This is the liability. Total of the present value will be the liability component. How much you have received proceeds? We have received the proceeds of 50,000. The difference between the present value of liability and the proceeds is nothing but the equity. Is it clear to you?
Yes, doctor.
Good. Yes, Fatma. Okay, now what we'll do, see, when the moment is there, how much is the liability is there, here we have calculated the same process, what we have done previously. The same process, 44,291. Here, what we are doing, adding here we are adding the equity. We take 44,291, okay, we are measuring the liability at amortized cost, what we have done in the previous case. We will calculate the interest expenses at the rate of 15%. Okay, at the rate of, only thing is, the effective rate is interest 15%. We are paying cash payments will be at the rate of 10%. The same thing, 1, 2, 3, 4, 5. Okay, 5 equal to 2 plus 3 minus 4. Okay, 5 equal to 2 plus 3 minus 4. Okay, this is what we are talking in terms of the same process which we have done. Okay, the same process which we have done. Is that now what we are doing? Once we have done that, okay, how much is the equity is there? We have calculated equity. Equity is 5708. Okay, equity is how much? 5708. In the end, what we'll do? Equity is at the carrying amount as on 1st January 2000. All the bonds will be converted. All the bonds will be converted means how much? Equity will be 50,000. Equity will be 5,700. This we have calculated from the above. Okay, from the above we have calculated. From here we got it. Okay, from here we got this equity and 50,000 is the liability. Now, when you have the total of this, what they are saying? They are saying that we are going to convert it into 25 cents shares for one bond. Okay, one. How many shares? 2 shares. Okay, 2 shares. How much is that shares are there? 50 million is the value. Multiply by 2. How many million shares? 100 million shares. Slowly do it. This is point number 1. Okay, this is 1. Okay, for in the first one, what we'll do with conversion of 225 shares for 1. Therefore, how much is there? To 50 million is the liability, multiply by 2 shares, how much will get? 100 million shares will get. This 100 million will be issued with the nominal value of how much? With the nominal value of 25 million. Means 100 million shares. Okay, 100 million shares into what is the value of the each share? The value of each share is 25 cents. It comes to how much? It comes to 25 million. Okay, it comes to 25 million. The remaining, is that the remaining, how much is there? The remaining 30,708 minus 25,000. It comes to how much? 30,708.1. Should be classified, should be classified as a share premium. Now, till now we have done the share premium. Is that this is the first time? Means this is going to be the share capital. Okay, this is going to be the share capital, and the remaining 30,708. Okay, 30,708. It is going to be called as a share premium. All the bonds are converted into equity shares. Value of the each share is how much? 25 cents. Okay, but this is the book value. Over and above book value is the share premium. Is a share premium. There is no remaining liability because conversion is extinguished. Now you see the thing. Debit is other component of equity. Okay, how much is the share capital? See the thing first. You see the thing. How much is the share capital and share premium? 55,708.1. Initially we have credited the liability. Okay, credited the liability. Is that 50,000 is the liability, 5,708 is the equity. Now we will debit the equity and we will credit the liability. Credit the share capital and share premium. Slowly, one by one. I am saying first step is clear for you. Equity component.
Yes, Dr. K.
Next. Yes, Jasim.
Yes, Dr. K.
Second step, step 2. We have done this. We don't have any new thing here. Second step is okay.
Yes, Dr.
Third one is new one. First time you are doing it. Third step is we are doing the first time. Again in the next question we are going to do the same thing. Is that first what we will do? We will convert the 2 cents. We convert that 2 shares into the value of the liability. We will get now total number of shares. With total number of shares, we will say that how much it is there. 100 million value into 25 cents each share. The value that this is the total value. We will get 25 million. That is the share capital. The remaining 30,708 is the share premium. Is it okay?
Yes, Dr.
Okay. Next. Read this one. Craig issues 104% 3-year convertible loan. 2006. The market rate of interest on similar loan without conversion is 8%. The conversion terms is how much? 1 equity shares. For every 1 equity share, for every $2 debt. Conversion or redemption at par take place. How this to be accounted? If all shareholders elect for conversion, if no shareholders elect for conversion. What we have to do first?
Calculate the liability based on PV.
Splitting, okay? Splitting the proceeds, okay? Splitting the proceeds, okay? What we are doing here, we will calculate what is the liability and what is the liability and what is the equity. Okay, what is the liability and what is the equity? Now, how much is the interest they are going to pay? They are going to pay interest of 8%. Is it right? They are going to pay interest of 8%. How much? See, if you are taking, see, what is they are issued how much? Sorry, they are issuing how much? 1,004% 3-year convertible. Okay, 1,400. How much is the interest? Interest will be how much? Interest expenses. Interest expenses will be 100,000 times 4%. It comes to 4,000. Are you clear about this? Now, effective rate is how much? Effective rate, that is the discount rate. Okay, discount rate. Discount rate is going to be how much? 8%. Okay, discount rate is going to be how much? 8%. Fine. Now, okay, fine. What we are doing that? What is the, we are taking the year. Here we are taking the year. We are taking the cash flow. 1 minute. I will take the things what they mentioned. Is that what is the cash flow? Okay, year, cash flow, discount rate and present value. Year, cash flow, discount rate. See, if you can do it in Excel, do it. I'm again telling you again and again. Okay, any help you need, I will do it. Very quickly we can do. Okay, this is the year 1. When they have issued, see the thing, they have issued on 4th January. When they have issued on 4th January, 31/06 to, sorry, is it 31/12, okay, 31/12/206, okay, 31/12/207, 31/12/208. They have given it for how many years? They have given it for 3 years. Okay, 3 years. How much is the cash flow? Cash flow is 5,000. Sorry, cash flow is how much? Cash flow is 4,000. Okay, 4,000. The second year it will be how much? 4,000. The third year, how much is there? The third year will be 100 plus 4. Getting my point? 100 plus 4. 100 will be the principal, 4,000 will be the interest. Okay, 100. Now what is the discount rate? Discount rate is 1 divided by 1.08 to the power of 1. 1 divided by 1.08 to the power of 2. 1 divided by 1.08 to the power of 3. Tell me how much you will get? $4,000 divided by 1.08. 3703. 3703.7. 3704. And rounding off. Okay, divided by 1.08. Check very quick. 3429.35. Is that 3429? Next, 104. Okay, 104 divided by 1.08 to the power of 3. It comes to how much? 82,558. Eighty-two, 558. Are you clear about this? Check. Total is how much? $4,000 divided by 1.08. How much you'll get? Is it okay? Seven, 17 2 9 5 4 9 9 plus 3 2 1 2 1. How much you'll get? No, this is not. How much is there? 104. $82,558. It is there with you?
So total the requirement is for 3 years, right?
Yes.
Can you go back to the illustration?
Year 1,
Above?
year 2, year 3.
Because in the last year we will have 2 inputs here, not 1.
Yes, it is there, 2 inputs. 4,000 is there, 100 is there. Okay, 4,000 is there, 100 is there. Are you clear about this?
Yes, doctor.
How much you'll get? 89691. Is it there? If you do it in Excel, you will get the rounded exact value. Don't worry about the rounding of figures, okay? That is not a mistake, okay? Don't get panic on that, okay? Are you clear about this?
Yes, doctor.
This is going to be called as a liability. Okay, this is going to be called as a liability. How much is the proceeds are there? How much we got the proceeds? Okay, how much we got the proceeds? Proceeds is how much? Proceeds is 100,000. Proceeds are how much? 100. Issue 100,000. How much is the difference? Take the difference. Okay, that difference is going to be called as a equity. How much is the difference?
10,309.
So 10,309. Is it okay?
Yes, doctor.
Next. Second, what you have to do? Second, it is nothing but amortization. Okay. This is what they have mentioned here. They have mentioned measuring the liability. Step 2. Okay. Step 2. Measuring the liability at amortized cost. Is that year, opening balance, interest expenses. Is that interest expenses? That is the effective rate. Okay, interest expenses effective rate. What is the effective rate? 8%. Okay. Now cash payment is how much? Cash payment at the rate of 4%. Okay, same rules what we have done in the previous. Okay, you have the closing balance. How much is the liability is there? We have identified liability. Liability is how much? 89,691. Okay, year 1. Okay, year 1. 31/12/2006. Opening balance, we will take that balance only. How much is there? 89,691. Multiply by 8%. How much you will get? 89691. Same process what we have done in the previous cases. No way it will change. Okay, 7175.28. 7175. I'm not taking decimals. Okay, I'm not taking decimals. How much is the cash payment? Cash payment is 4,000. Okay, closing balance. Okay, closing balance. 1, 1, 2, 3, 4, 5. 5 equal to 2 plus 3 minus 4. How much will get? $89,691. Okay, 89,691 plus 7175 minus 4,000. Any one of you do in Excel. One of you do in Excel. I will be very slow there. If you are doing in Excel, at least plan from tomorrow. Plan from tomorrow. We have to do in Excel. Okay. How much is there? 92866. Check. 92866. You can round it off. Okay. If there is any difference in round it off, don't get panic. 2007. Okay. 2007. 92866. Is it 92 times 0.8%. Okay. How much is the 7429? 7429. How much is the 4,000? I am putting 4,000 in brackets. Okay, with that we can do like this. Nothing will happen. Okay, now 92866 plus 7429 minus 4,000. How much is the 96295? 31/12/208. Okay, 96,296,295. Seven 7036, 7704, 4,000. How much you'll get? Tell me. Almost you are getting how much? Almost you are getting 999, or okay, or you can put it as 100,000. Are you clear about this?
Yes, Doctor, clear.
Okay. Yes, Jasim.
Yes, doctor. Professor, good.
No, step 3. Okay. This step 3 is the conversion. Okay, step 3 is the conversion. How much is the conversion? Total amount will be how much? Equity is how much? Equity is how much? I calculated equity. Equity is 10,000. Okay. Liability is how much? Bond liability is how much? Liability is 100,000. Total value is how much? 110,309. Okay. Now, how much is there? They are going to is value, book value is how much? Your liability value is how much? reporting process. Is it? This is what we are doing. We are talking in terms of the forward contract. It will be there recognized on the commitment date. Okay. Option contract will be recognized uh, when contract is entered. Okay. When the contract is entered. Okay. When the contract is entered. On the date the contract is entered, when it is going to be effective. Okay. Are you clear about this? One, two, and